We're looking at a research note on Rezolve AI.
The RZLV piece, yeah. The one with that huge $15 price target from Maxim Group.
Exactly. A massive target, a 500 million ARR guidance for 2026, and all of that against a $1 billion market cap on tiny current revenues. Let's jump right in.
Okay, so the headline here is obviously that extreme risk-reward profile. That potential 400% return is the whole hook.
It is, but I think the first area for improvement is how that risk is framed. While the report correctly identifies RZLV as a high-stakes show-me story, the extreme financial disconnect should be foregrounded to establish the scope of the risk immediately.
So you're saying lead with the scary numbers? I mean, don't you risk losing the reader's excitement if you hit them with the $1 billion valuation right away?
I see that point, but the weakness here is in the pacing. By delaying the punchline, you sort of minimize the shock value. That $1 billion valuation against just, $5.3 million in trailing revenue and a $217 million loss? That's the real story.
It's not just a disconnect, it's a chasm. So the suggestion is to recalibrate that structure.
Yes. Juxtapose the explosive growth metrics, like that 426% year-over-year revenue growth, directly with the frankly jarring valuation.
Make the tension explicit from the start.
Exactly. So instead of waiting, you could say something like, the 400% return potential hinges on flawless execution, particularly given this $1 billion valuation currently stands against only $5.3 million in TTM revenue. It makes the stakes clear immediately.
Okay, I like that. Once you establish that massive risk, the immediate next question is, well, how? How could they possibly pull it off?
And that leads right into the second critique. To bolster the bullish case and justify the massive projected acceleration, the report needs to connect the technological drivers more explicitly to those aggressive financial targets.
Right. Because the weakness right now is that the thesis just sort of lists the assets.
It does. It relies heavily on just naming things. The partnerships with Microsoft and Google, the proprietary tech like Agentic Commerce.
And the brain suite.
Right. But the connection between those pieces and the actual scale-up mechanism is stated, not really analyzed.
So the suggestion here is to give a focused analysis of the how. How does something like one-tap checkout and a Google partnership translate, $6.3 million in revenue in H1 2025 into a $500 million ARR in just 18 months?
Precisely. We need to explore the potential growth mechanism.
For instance, is the model based on just adding more clients, scaling up from their current 100 or so like H&M and Ferrero?
Or is it about maximizing revenue per user through a much deeper integration into, say, the Microsoft ecosystem?
Yeah.
Just acknowledging that defined pathway would make that very ambitious $15 target feel a lot more justifiable, even if it's still a long shot.
Okay, so a really focused discussion today.
I think so. The two key takeaways are really about structure and depth.
First, strategically framing that severe valuation gap right at the beginning, it maximizes the drama of the whole high-stakes thesis.
Exactly. Don't bury the lead. And second, provide a much tighter analysis connecting that core tech and the big partnerships directly to the execution path.
Show us the road to $500 million.
You got it. Implement those changes, really sharpen that narrative, and